Here's what I've learned after 1 full month of studying and backtesting the Elliott wave theory. The key to using the Elliott method successfully lies in counting the waves correctly and identifying the wave in which the market is currently trading in. That's it. Identify the wave and you'll profit from it. Today I will try to help you better understand the general characteristics of the different waves within the overall market structure. Learn this, and the Elliott wave theory will become much simpler. Before we begin, if you want more videos more often, please drop a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. One of the key points within the Elliott wave theory is the concept of the fractal nature of the markets. This means price patterns repeat themselves over and over again on all time frames. Under the Elliott wave theory, there are two types of price progressions. The first are those price movements or waves that are aligned with a larger trend. These price movements are referred to as motive waves. The second price movements are waves that are contrary to the larger trend. These price movements are referred to as corrective waves. Motive waves can be classified further as impulse waves or diagonal waves, depending on the form and location within the overall structure. Impulse waves are the most common form of motive waves and the easiest to spot in a market. A diagonal wave also moves the market in the direction of the trend. The difference is that the diagonal wave looks like a wedge, either expanding or contracting. Corrective waves are generally classified as either flat structures, zigzag structures, triangle structures, or double or triple combinations. The basic form of the entire Elliott wave sequence is comprised of 5 waves that make up the motive wave, which are labeled waves 1 through 5. Following the completion of wave 5 within the motive sequence, the market will develop into a 3-wave retracement that moves contrary to this motive wave sequence. This retracement move consists of 3 waves, labeled as waves A, B, and C. If you're just starting, there are only 3 unbreakable rules as it relates to the Elliott wave principle. The first rule is that wave 2 cannot retrace more than 100% of wave 1. The second rule is that wave 4 cannot move into the territory of wave 1. And finally, wave 3 cannot be the shortest wave amongst wave 1, 3, and 5. So like I said in the beginning of the video, if you learn to recognize the current wave of the market, you will be ahead of most traders. Now let me share the characteristics of the various waves within the Elliott wave structure in the context of a bull market. Pay attention to each description, and by the end of this video, Elliott wave theory will no longer appear complicated. Wave 1 begins the impulse sequence. During this wave, price begins to bounce higher after a long sustained downtrend. The sentiment in the market is very bearish at the start of wave 1. As wave 1 moves higher, most people see this upside price movement as just a bear market rally, and many investors and traders consider wave 1 as a good opportunity to initiate a new short position or add to their existing short positions. Wave 1 is generally the least predictive wave within the entire Elliott wave structure. There is really no way to know how long the wave will last. However, at some point, it will become clearly apparent that the wave 1 has ended as a significant swing high is reached, and prices begin to move lower in a bearish direction once again. Wave 1 generally subdivides into 5 smaller waves and can sometimes appear as a leading diagonal structure. After wave 1 completes, the next one in the sequence will be wave 2. Wave 2 will move counter to wave 1 and will retrace a large portion of wave 1. Often, wave 2 will retrace wave 1 by either a 50% retracement, a 61% retracement, or even a 78% retracement. During wave 2, investors and traders begin to feel assured once again that the downtrend has continued. However, the market will fail to break below the wave 1 low. Remember one of the unbreakable rules within the Elliott wave theory, which is wave 2 cannot retrace below the start of wave 1. Informed traders will begin to recognize this pattern and start to position to the long side of the market. Wave 2 will generally take the form of a zigzag correction or a flat correction. In either case, the retracement will be fairly deep. Additionally, since wave 2 is a corrective structure, it will develop as an ABC pattern comprised of 3 waves. Wave 3 offers the largest potential for profit, as it's usually the biggest and the most powerful wave within the overall Elliott wave structure. The psychology of traders during wave 3 is generally one of growing optimism. Although many of the earlier sellers will still resist the optimistic outlook during the early stages of wave 3, it will become increasingly evident to most traders that the trend has shifted and the markets are poised to move higher. After the break of the swing high of wave 1, prices will begin to accelerate upward as more and more traders recognize the bullish sentiment and start taking long positions. Additionally, many sellers will have their stops triggered at the wave 1 swing high, which adds further fuel to the upward price momentum. If you identify the third wave, you need to join the trend as quickly as possible in order to take advantage of the explosive moves that are characteristic of wave 3. Those that wait for a pullback or a retracement to get in will often miss the entire move, as wave 3 offers very little in the way of pullbacks, and when they are present, they tend to be quite shallow. Wave 3 will often travel 1.618 times the length of wave 1 measured from the end of wave 2. The second most common projection for wave 3 is for it to travel 2.618 times the length of wave 1 measured from the end of the wave 2. One of the guidelines within the Elliott wave principle is that among waves 1, 3 and 5 of the impulse sequence, there will be one extended wave which will be larger than the other two. In most cases, wave 3 will be that extended wave. Wave 4 will follow wave 3 and will retrace a portion of wave 3. Typically, wave 4 will be a shallower retracement and will often terminate at 38% or 50% of wave 3. Since wave 3 is often the longest wave within the overall sequence, we can expect wave 4 to be less aggressive in percentage terms than wave 2. Also, you need to keep in mind one of the core rules within the Elliott wave theory during wave 4. This is, wave 4 should not overlap into the territory of wave 1. If it does, then you need to relabel your wave count, as this is an unbreakable rule. Wave 4 is also seen as a profit-taking wave, because those traders that bought early in wave 3 are sitting on a healthy amount of profits. Many of these traders will begin to liquidate their positions and lock in their profits. This creates a sideways price movement that is often prolonged in nature. Wave 4 often takes the form of a triangle. However, wave 4 can also be a flat formation, and sometimes it forms a zigzag pattern or some combination. The price action often appears range-bound, with price moving back and forth without any clear direction. Wave 4 brings with it whipsawing price action that often creates false breakouts on either side of the market. You need to be very careful when taking new positions during wave 4, as you are more likely to lose money during these directionless market conditions. Wave 5 is the final leg within the Elliott wave impulse sequence. It moves in the direction of the overall trend, similarly to wave 1 and wave 3. During the progression of wave 5, almost everyone is bullish. Wave 5 is often considered a retail wave because it is during this time when most retail investors are driving prices higher, often to extreme valuations. The momentum behind this bullish activity in wave 5 will be less dynamic than during the wave 3 progression. This basically means that the velocity of the price movement will be more subdued than that seen during the wave 3. During the late stages of wave 5, we will also see technical divergence patterns that form between the price action and many momentum indicators, such as the RSI, stochastics or the MACD. These momentum divergence signals are telling us that the velocity of price movement higher is diminishing, and we should expect the upside trend to reverse soon. Along with momentum divergences, wave 5 will often register a lower volume compared to wave 3. This is another indication that the trend is weakening, and that the profits should be locked in, as a potential reversal is imminent. In terms of how far wave 5 will travel, well, wave 5 will terminate upon reaching a length that is equivalent to the length seen in the wave 1. The next most likely projection for wave 5 is for it to travel a distance of 61% the length of wave 1. Both of these projections for wave 5 are measured from the end of wave 4. The end of the wave 5 brings with it the completion of the impulse sequence. More specifically, the impulse sequence consists of wave 1 through 5, and thus, at the end of the wave 5, we can expect a corrective structure to follow, which will often be a three-wave pattern, waves A, B, and C. Wave A starts the corrective sequence, and during this phase, most traders are still very bullish and consider the wave A pullback as just another minor retracement. Wave A is somewhat similar to wave 1 in its structure. During both of these wave progressions, the market participants are heavily positioned on one side of the market, depending on the direction of the larger trend. However, just as in wave 1, some experienced traders begin to recognize the overbought market condition during wave 5. Wave A is often a sharp move that may subdivide as either a 5-wave pattern or a three-wave pattern. Wave B is the second leg of the corrective structure and follows wave A. Wave B is often considered a bull trap because it tends to draw in a lot of traders, believing that the existing trend is still healthy. However, this is far from the case. Wave B will be a fairly short-lived pattern and will often fail to surpass the wave 5 swing high. Wave B will often create a double top formation in which it will try to test the wave 5 extreme and fail to breach it. This doesn't always happen, however. It's quite characteristic for wave B to terminate just short of the wave 5 extreme. Wave B is often a fairly deep retracement and will retrace wave A by either 50%, 61%, or 78%. The subdivision within wave B itself is often seen as a zigzag pattern, but sometimes it will form as a triangle as well. One of the best trades within the Elliott wave sequence is to fade the wave B price move as it nears its terminal point. After wave B completes, wave C will begin, and this wave marks the final leg within the entire corrective structure. When the wave B swing low is taken, that event will mark a turning point where more and more traders will become convinced that the uptrend has actually ended and the market is poised for lower prices. Wave C has many of the same characteristics as wave 3. Both wave C and wave 3 tend to be relatively long waves and can be quite powerful from the momentum standpoint. Wave C is often equivalent to the length of wave A. Wave C will travel a distance of 1.27 times the length of wave A. After this distance, the next most likely area for wave C to terminate would be when it has traveled the distance of 1.61 times the length of wave A. Now that you know the characteristics of each wave, let me share a simple checklist to apply to the sequence. Print it or write it down and use it every time you are unsure about the current wave of the market. Wave 1, Wave 3 and Wave 5 are trending. Wave 2 and Wave 4 are corrections. Of Wave 1, Wave 3 and Wave 5, Wave 3 must not be the shortest, but it doesn't have to be the longest. Wave 2 can retrace up to 99% of Wave 1. Wave 4 should not go into the price area of Wave 2. Wave 4 never enters the price territory of Wave 1. Wave 2 and Wave 4 must display alternation in as many ways as possible. That is, Wave 2 and Wave 4 must be different in as many ways as possible. Alternation occurs between Wave 2 and Wave 4 as either price, time, or pattern. In terms of price, Wave 2 when compared to Wave 4 may be obviously smaller or larger in price. In terms of time, Wave 2 when compared to Wave 4 may take much more or less time. And in terms of pattern, Wave 2 may be a simple ABC, Wave 4 could be a more complex ABC or even a triangle. Or Wave 2 could be a flat formation and Wave 4 could be a zigzag or vice versa. If you enjoy this type of content and want more Elliott Waves videos, leave us a like to show support and to help us with YouTube algorithm. And in future videos we'll go even deeper with more advanced strategies that can be applied to day trading and swing trading. Until next time.